Hey, Joe, good afternoon and welcome to another decompression session for Scuba. Thank you for being here today.
It's my honor and privilege. Let's help some people.
I think that's a great idea. We're going to talk a little bit today about some things that are, I think, newsworthy that are happening today that I think, well, I don't think, I know will have an impact on our clients and every other business out there. You and I have chatted about this, last week. We've got the Fed raised interest rates again.
And they expect to raise it, what, 6 more times this year? Something like that?
Yep, something like that. We've had three primary banks, three good-sized banks that went away. We had Silicon Valley Bank, Republic Bank, and Signature Bank have all gone away. They got absorbed or whatever is happening there. That has an impact on anybody who was dealing with them, of course. Then there was this speculation that it's just the tip of the iceberg when it comes to what may happen with other banks in the system. Okay. And then I just saw something the other day that talked about the difference between the very large banks, okay, like the B of A's and the Wells Fargo's and the Chases and the JP Morgan Chase, and the smaller community banks, a lot of whom are solvent because they were prudent with how they spent their money, and then that mid-range group that are maybe hurting. Okay, so it was very interesting, and all of that is going to have an impact on how people, our clients, are going to operate, and how our clients' customers are going to be able to operate. True?
I agree completely. In fact, I've got 2 clients that actually, two that banked at First Republic and a couple that banked at Silicon Valley. That actually went through the challenges of that and the stress factors of that. Right now, I just was reviewing financials and the interest rate impact on credit cards. We're going to talk about here in a minute. That the interest rates on credit cards is astronomical now and going to continue to go up. So this is a time to do a timeout, dive into your financials, and start figuring out. And we're going to make some recommendations on what to do in that space.
Right. I'm going to ask you another question before we dive into that, because there's just like lots of banks, and a lot of these community banks promote and push getting small business clients. I mean, that's a large percentage of them, and I've worked with a lot of them when these smaller banks, when I was in the financial services industry. I was selling factoring services, right? And so you interact with them, and because the thing I was going to ask is, all banks are public entities, and therefore, or at least I believe they are. And then, so their annual reports and financial basics are published, and you're able to take a look at that. Does it make sense? Is it prudent for a small business owner who may be banking with XYZ Bank, that's not, a super big one, to take a look at what's going on with the bank that they're dealing business with?
I think they can. I think it is probably a waste of energy.
You think it's a waste of energy?
Yes, because first of all, I can make financials look just about any way I want to, and so can the banks.
Okay.
So you might see something. Should you do it? That's up to you. Could you do it? Absolutely. I think that most of my clients anyway have got more than enough on their plate than worrying about what bank that they need to be banking with. So select a bank that's going to be stable, that you're looking at. I'm actually have a lot of my clients looking at credit unions versus traditional banks.
Oh, yeah.
And is it slightly different? Yes. But I've got a lot of my clients that are looking at credit unions And a lot of the credit unions now are doing business banking.
Yeah,
So
exactly. I've seen that too. I mean, it used to be 10, 15, 20 years ago, then they weren't doing the same kinds of things, but they are today, and they've been able
they,
to extend out into and that's a good point. That's a really good idea. Yeah.
I like the idea of at least considering a credit union versus a bank uh, for a small business, especially that you still get the customized service, you get the
Yeah.
a lot of the benefits of a small bank, and utilize the credit union, and it's a nonprofit, and there's a lot of benefits to the credit union space.
Cool. All right. Well, thank you for that. I think that's a good piece of information for our customers to be aware of. So I'm going to share my screen now, because we do have some information to share that is relevant to this whole area. And we wanted to talk about that today, which is this interest rates and how that impacts your business and all that kind of stuff. So I guess one of the key things is that it's important for our clients to think about exactly where this is going to hit them. Okay.
Absolutely.
Because you may not think that it is going to, but there's two sides. There's what it does to you, which is this where we're going to talk here, but it's also, it hits your clients too. So it hits your customers. So if it hits them and it hits their customers, both sides of that equation are going to have an impact because of this increasing interest rates. And together, they're going to have a significant impact on what happens to your business. So let's take a look at what happens to you, Mr. Business Owner. It's going to hit your credit cards, right? I mean, if
man, Dave, I pulled out a couple of my clients' credit card statements, and it was 25.7% interest rate.
Ouch.
Yes.
Ouch. That's
and
painful.
and they didn't realize that it just every 6 months or every 3 months or whatever their adjustment cycles are, it creeps up. So if you've got credit card debt, focus on getting rid of that and moving it to, if you have to have debt, move it to a fixed rate debt.
Right. Right. Yeah, I mean, it's easy to allow that stuff to creep up. And it's fast and easy to use the card to take care of things. You need to get some more merchandise, or you need products to maintain your operations, or or you're going to rent a car when you go on a business trip, and you got to go to Southern California, so you're going to rent a car and you pay by credit card. All of this stuff, it's so easy to do, but if you're not aware of what's going on and taking proactive measures to retire that debt, you can find that you're in trouble.
Yeah, a credit card is a great tool to use if you pay it off at the end of every month or the end of every billing cycle.
Right.
If you don't, it is not a good tool, because that 25% interest rate or whatever your interest rate is, that I'm seeing them anywhere between a 19 to 25, 26 right now, and it's going to continue going up.
Yeah.
So get your credit card, get that balance off of there, use it as a tool, which means you've got 1 month of free money. Use it, but don't abuse it, because if you carry that balance over, you're going to be hit with those charges.
Here. Okay, so that's one area, place where it hits them. It also hits them with their business loans or a business line of credit, because banks, especially if it's a variable rate loan. If it's a fixed rate, well, that's one thing. But if it's variable rate, that's quite another. And then trying to get a business loan or a business line of credit today is more complicated. It's not as easy. Plus, the rates keep going up. At least that's what I've been seeing.
The rates are going up, not only for your business line of credit, your line of credit. Look at what if you're going to start using your business line of credit, check and see what the rates are. Now, your business line of credit rates are probably better than your credit card rates. Okay.
Interesting point.
So if you have to utilize debt, look at your line of credit, because your LLC, your line of credit, might be much better utilization than a credit card.
Got it. Interesting
The,
point.
the best utilization is no debt or leverage that 30 days. The other things is if you've got an IDA loan or you've got some of the PPA loans and you're paying some of those back, most of those are fixed rate, like 3%. And that's not right now. That's that's a good use of your cash flow. Looking at paying the minimum on that, maybe if you've got higher interest rates, and look at paying off the higher interest rate ones.
Got it.
So you've got to kind of prioritize things. Credit cards are going to be the worst. Get those down to zero. A business line of credit is probably going to be somewhere next. If you've got other loans or things, you have to evaluate them and make a good conscious decision. Talk with your accountant, because they can help on this also.
Got it. Makes sense. Okay, so it hits these guys because their credit card APR goes up, their line of credit rate goes up, their business loan rate goes up. And the other thing that we didn't mention is if they're using credit cards, the processing fees are going up, aren't they?
Yes, they are. And most people don't even notice that. So you've got to check out your credit card processing fees. As that goes up, that will impact your profit and loss. What 1% doesn't sound too much, but guess what? 1% of your net is a lot.
Yeah. And each one of these things, it's like, oh, there's a little bit here, a little bit there, a little bit here, a little bit. So it adds up, and it keeps creeping too. I mean, the credit card processing world looks to leverage their activity because they have, everything, the expenses are going up for them for all the things that they're doing in the processing of these transactions and the movement of the funds that are associated with that. And so they're going to come back to you, Mr. Business Owner or Mr. Consumer, and take it out on you because they're trying to increase their profitability as well.
Well, everybody's got to make a buck.
Right.
Okay. If you're not making some money, you're not going to be in business for very long. So they're trying to make this money also. So we understand it, but you've got to be prudent in your evaluation of where are your funds going, where's your expenses going, and you need to evaluate these. And this is probably the priority to go in to look at from your business perspective. Now, the other things to look at when I say business loan, if you've got a mortgage rate, a variable mortgage rate on a property, a business property, you've got to look at that also. And so, if you're more, if you've got a commercial loan, what are the terms on that? And they may or may not be fixed. If they're fixed, well, hopefully you locked it in that low rate. If they're not fixed, you might want to look at trying to, things are going to continue to get worse, not better, or that's the outlook.
Right. Okay. And this is, I think, very what's interesting to me about what we're discussing here is that it's not like as a business owner, you don't have like a zillion other things that are going on that are commanding your attention. Personnel, supply chain, getting new customers, customer service issues, somebody's out sick, all that sort of stuff. That's just constantly going on. This throws a whole other variable into it. So now it's like that, is the spinning plates thing. Now there's just one more that's spinning that you have to try to deal with right now. But this one, if you don't deal with it, is going to have a significant impact on your bottom line.
Well, this is why we talk about brainSHARE. Where is your brainSHARE? When you put on that CFO hat, that's when you dive into this. Okay, so you've got a lot of spinning hats. You're absolutely right. But if you're trying to think, in a analytical fashion when you're diving into financials, but your brain is worried about your employees or customer service or operations, you're going to struggle. So you've got to get in that modality of financials. Dive into the financials and stay in that modality for 45 minutes to an hour and a half just like we talked about in brainSHARE on the time management aspect of things.
Very cool.
Then and it's not going to take long once you're focused.
Right.
If you're not focused, I literally I spent about an hour with one of my clients last week diving into this, and we got it all taken care of. Oh, guess what? This credit card, we're going to pay off this, and we rearranged everything in 1 hour. We had it all figured out.
Great. Okay. Makes sense. All right, let's get back into take a look at this little list of things here. Okay, so we talked about how it hits you, Mr. Business Owner, but you have to also recognize that this is going to hit your customers too. I mean, Joe and
Absolutely.
Jane Doe walking around the street, they're going to see everything is becoming more expensive. I mean, come on. I mean, it's just like a gallon of milk, whatever it is, stuff is not getting cheaper.
A $5 footlong is $12 now.
$5 footlong is not $12. Exactly. You know, I mean,
Well, and it's not only the interest rates that are affecting that, it's also the inflation rate.
Right, exactly. Interest and inflation, true. And then, so prices are going up on all items. Their credit card rates are going up. Their mortgage rate, you know, if they were on a variable, is going to be going up. It's just like the pressure is on the consumer, and that's going to have an impact on the business owner, because if consumers have less discretionary income, then you have to be aware of the fact that you may not be getting some of those impulse sales that you might otherwise get.
Or the wallet share is going to get smaller because they don't have the money in the wallet. Okay.
Exactly.
If you know, people are getting laid off, you know, there's all these other variables that also have impact into this, into this situation.
Right.
We've got a bunch of layoffs going on. So guess what? Money's going down. People aren't getting the raises that we want. Inflation's going up. Interest rates are going up. That means that the money that's available is getting squeezed.
Yeah, exactly. All right, so let's summarize here. How does the business protect itself? How do you as a business owner take care of yourself? Pay off your credit cards monthly is the one thing that you said. It makes an awful lot of sense. Use the tool, but don't abuse the tool.
That's right.
Okay. Other one is avoid variable credit rates, the variable rates on lines of credit. That's an interesting one. I have not done a lot of looking into what fixed rate activity is, or whether banks are moving away from fixed rate and starting to really aggressively go for variable rates. But if you can avoid a variable rate situation, that would be the way to go. Yes.
Absolutely. Even if it's a little higher than you'd like right now, you might get a lower variable rate starting out, but guess what? All the projections are it's going to go up. So it's probably better to lock in a little bit higher rate right now that you're going to be able to keep, especially
that you can predict.
That it's going to be more than 5 years, almost any amount within a year. Now, in 5 years, the rates might go down. Guess what? Then you can refi.
Exactly. Well, that's what a lot of homeowners did when the mortgage rates went down. They went and refied at a lower rate, which was fantastic. But they were locked in to maintain what was at the time looked like a really good rate. So that's the approach to take. Okay.
Absolutely right. Review your credit card
processing fees.
I get somebody to help you with that, because some of those credit card statements, the processing fees for the business itself, they're hard to analyze. Mm-hmm. So get a professional to help you there.
Right. Cool. All right. Possible other actions you can take as a business owner. One is to plug the financial holes, because it's interesting that we don't always realize where our funds are going. And, it's just like you spend $5 here, $10 there, whatever, you pick up. It's like, you can buy the super expensive premier cup of coffee at a place like Blue Bottle, or you can go over to McDonald's and get a cup of coffee for $1, and the difference in the actual coffee is almost nothing, but you're spending $7 more for the one at Blue Bottle. So how do So there are some financial holes that you have to recognize is going on there. If you can assess those and start to plug some of those, it's going to help you. Am I correct in that?
Yeah, yeah. Or you could make it yourself for 25 cents.
That too.
Okay, and your coffee, your ROI on a coffee machine in today's world, if you're going to Starbucks, I think is about 2 weeks.
Yeah, yeah. So plug your financial holes, and there's ones that you don't even think about that are there. The second thing is you could potentially raise your prices, and a lot of businesses, large businesses, good sized companies are raising their prices because
You're gonna have to, Dave, because when you start analyzing your cost of goods sold, your supply chain coming in, those prices have gone up. If you're not looking at your inflation, your employee costs, which are going up, insurance costs have gone up. You really need to evaluate your prices almost on a quarterly basis now, at a minimum.
Ooh, that's a good point. Reassessing on a quarterly basis, because I don't think most companies do that even annually.
Most companies annually is about, I think is fairly normal, but quarterly is the case now.
Quarterly is the case. Good. Okay. Find no-cost ways to improve service. I think this is an interesting one, because one of the things that is important to understand is the lifetime value of a customer. And if you can keep the client coming back to you, keep them purchasing from you, even if today they're buying a little less than they bought last month because of what, they have a little less discretionary income, they're still coming to you. And if your price, might be just a smidgen higher than the guy down the street, the question is, do you have a bond with that company? Are they going to recognize the fact that I like doing business with Joe because Joe always does this, or he takes care of that? I can rely on him. I know the service is going to be the same. I know the product is going to be consistent. So if you can find ways to improve your service, you have a higher probability of locking those customers into your business. True?
That I just had a conversation yesterday with one of my clients, and we were talking about the Porsche services. Now, and guess what? Two different facilities have two very different customer service relationships. Okay, there's one right here that my wife goes to, and they keep her informed, every day of what's happening, what's going to go on, and then I talked to a client last night and said, "Oh, I do this. I didn't know what was going on for 3 days."
Oh, wow.
Customer service is all about setting expectations, meeting your commitments, and keeping your clients informed, and just being polite.
What you just explained against those two, letting your customer know what's going on costs you no money.
Exactly.
You can send them a text message, you can send them an email, you can leave them a voicemail. It doesn't cost anything, but it gives them confidence in you, in your company, and it binds them to you. That's really important. That's a very good one.
Yeah, the most important thing is, from my perspective, and I'm an expert of this, keep your customers informed about what's happening.
Yeah, very good. And then the other possibility maybe is time to pivot.
I was just had a call this morning with one of my clients that they're getting squeezed on one of their product lines, so they're pivoting to another product line where there's more margin. Now, this product line was great for the last 10 years, but as it gets squeezed, the marketplace isn't there, and they're going to have to pivot to another product line that's more profitable to keep things rocking and rolling.
Right.
It's okay. This needs to be evaluated on where can you pivot? When should you pivot? Should you pivot?
Right.
These are all things that really take some brain share.
Got it. And pivoting is not a negative thing. It can be a massive enhancement to your business, not just a temporary thing because of circumstances, but it can actually move you into a market that you may not have realized that you had the opportunity to get into.
Well, and sometimes if you don't pivot, you could be you could be in real trouble. I mean,
Yeah.
talk about people that didn't pivot. BlackBerry,
Oh, yeah.
Net, Blockbuster.
Oh, yeah, right.
There's lots of examples of opportunities to pivot that you didn't, and not good things happen. So it's always appropriate to look at the environment, what's happening, when should you not pivot.
Got it. Okay, so there you go. Thank you, Joe, for that conversation. I hope our clients have realized the opportunity. Get rid of this here. They have realized the opportunities that we're talking about. This is significant because this is real, what's happening today. And we want them all to thrive. And, we want to help as many businesses. I think you've got a target to help 10,000 businesses a year.
That's correct. So,
if we can do that.
we did a little pivot last week in our business on who our target market is to achieve our objectives. So it's normal to do some level of pivoting. We realigned our target market, and that's normal business. You should be doing that.
You should be doing it. All right, my friend. Well, thank you so much, Joe. Pleasure to have you back here. And we'll see you next time we have another scuba session.